All right, well, good afternoon. Welcome to our October 8th, 2024 edition of Bull Sessions. My name is Mark Robertson, and I am joined here underwater with my colleague, Ken Kavula. Good afternoon, Ken.
Good afternoon, Mark. Good afternoon, Matt. Good afternoon, Diane. We're so glad to have some of you, all of you, with us today. And this is going to be a very interesting, it's not a round table, it's a bull session, a very interesting bull session today. I'm looking forward to it, Mark.
All right, Kim's not able to join us. She's taking care of some business, and then she's going to escape the Florida hurricane situation. And we are all joined here by Matt Spielman from Houston. So good afternoon, Matt.
Good afternoon.
Matt will be lurking and answering questions and chiming in as he sees fit. And we do have a very special guest. This is somebody that I have known for, I don't know, the better part of 3 decades. We used to refer to her as Bunny Scoot, and she still does go by that nickname. So welcome to Diane Bunny Scoot Grace this afternoon. How are you, Diane?
Happy to be here.
Diane has some
Glad to join you.
Yeah, your experience is fascinating, and Diane was among many that chimed in to help us with the current topic, the treasury stock and share repurchase and buyback stuff that we're going to be going into in some detail. So we do have an extremely full agenda here today. Be forewarned that we might go over by a few minutes, but I don't know. I think it's worth understanding this stuff, and I am just so thrilled every time we gain a little bit deeper understanding of some of this kind of stuff. The fish have rejoined us because, again, we talk about the fish is also another representation of small companies. If you don't know the fact, a goldfish is limited by the size of the bowl that it's in. It will only grow so big, but if you turn that same goldfish loose in the pond of a hotel, it will get bigger. And obviously, if they jump out and leave, hopefully they land in a nice tributary or body of water. If not, it can be ugly. But no goldfish were harmed in the making of this presentation.
I don't know what I was thinking, Mark, but against my better judgment, we also have a friend from the Washington, D.C. area in the back room today. Maybe I can get him to pledge to be good, okay? I don't know. We'll see.
It's asking a lot. Good afternoon, Kevin. Well, his ears must have been burning in advance here because he's on the second slide. We have an announcement here. It is not hot dog related. It's a competitive threat to hot dogs. This is our weekly reminder that Portillo's is not a sponsor of this session, but they should be. And come Thursday, and this is probably the Kevin Gologly burger, the Chicken Big Mac will be released. And bit of a competitive threat. Kevin, are you going to go out and get one of these? He's probably not ready to even speak.
Well, he's self-muted right now, so
Okay.
maybe he's away from the mic. I don't know. We'll see.
He might actually be at work. He can join us if he gets an opportunity. But for those of you that weren't aware, that is the case. And I did put the yellow or orangey line across the price chart on the lower right because that's my cost basis. And I want you to notice where that upturn actually...
There's resistance at the cost basis.
That's what I was just going to say, otherwise known as the line of resistance.
That is my cost basis, believe it or not.
We should call that guy that's the chartist on CNBC and have him come out and take a look at this, Mark. All right.
All right. Wasting enough time on that. All right. Here is our standard disclaimer. No investment recommendation is intended. This is entirely about education. We're going to talk about some methods, philosophies, and techniques of the modern investment club movement. You'll hear opinions from us, but please, please, please form your own conclusions and make your own decisions about any potential investment. If we own something, we'll try to remember to disclose it. We are going to talk about Buttonwood today. The next roundtable is a few weeks out. If you have any needs, including slides, Q&A, or suggestions for future topics, our 2 email addresses are right there for you to use. Good to go, guys?
Good to go, Mark. Let's do it.
Ready?
All right, we're going to stop for a moment and just recognize a champion of the better investing community going back for a few decades. We lost a great one this past weekend. Jerry Pillins, I've known him also for the better part of 3 decades. And he was a staunch advocate for individual investor and investment club based education. and he will be missed. He put on a number of programs. He was a marshal, kind of a sergeant at arms behind the scenes for the most recent national conventions, and he will be very deeply missed. Anybody have anything you'd like to add?
Well, Jerry chaired the education committee for the last 3 conventions, Mark. So Jerry,
Mhm.
along with Marianne Wrench from Ohio, chaired the education committee. So he did more than just marshal and sergeant at arms stuff. He worked a lot in program as well.
No, that's what I meant. I mean, he basically did a bunch of stuff that will
Yep.
be deeply missed. Matt, any comments from Houston? He's one of your neighbors.
Yeah, I met him shortly after I attended my first Houston Model Club as a guest, and I was a chapter director within 4 months, which I don't think is typical. I was readily recruited to build up their strength, so I've known him for 3 years now, and yeah, he definitely was a voice everyone turned to when questions arose and other people didn't know the answer.
All right, so thanks,
I
Jerry.
served with him on the computer group board.
Absolutely. All right, so Jerry, rest in peace and thank you for everything that you've done. All right, here is our weekly chart highlighting the stock market as measured by the value line arithmetic average. And you can see that it's actually zigged up and then zigged down to just below the blue line. But all of the major forecasts seem to be right in that 9%-ish range. Any comments here, sir?
No. Is that last? Well, the last bar is closed now, so we're going to have a light green bar on the end there pretty quickly. Maybe it is light green already, and I'm not seeing it, Mark. I don't know.
We need to buy you a better screen.
We do. We do.
All right. Let's keep marching on. We've got a pretty full agenda here today. Here's just our quick performance perspectives, again, sharing what is possible, not guaranteed, but possible when investing in individual stocks. Those numbers up at the top are knock it out of the park. Fantastic. All of the index opportunities to invest are clustered there towards the bottom. We do believe that the Tin Cup demonstration is basically a 401k demonstration going back to 1994 is pretty cool. And the Investing Roundtable is our community-based effort that is now going. We're in our 15th year, and as a group, collectively making some wonderful selections over time. All right, we'll press on. Here's a quick update on the groundhogs. First thing on the right, just this is going to kind of burst into an AI type session. Just wanted to share that those 2 pictures of groundhogs were generated by 2 different graphics generators, one from Google and one from Twitter or X. And the same input went into both, and you can see the dramatically different results. I tend to think of our community as the one on the right. And I don't know, that's kind of Wall Street on the left, I think, but I think it's appropriate next to Jim Gallagher's name because Jim Gallagher had a stock actually go to zero. One of his groundhog selections for this year, he only has 5 selections. So $200,000 has disappeared. Do you think it bothers him?
He's kind of showing off at that point. That's like I'll fight you with one arm tied behind my back.
I have a feeling it doesn't bother him a bit. It was Big Lots, by the way. Big Lots went into bankruptcy and disappeared. The ticker is now gone. So, and anything else you
Well,
grabbed on
I'm
this one,
keeping
Ken?
track of the number of clubs in the top 40, Mark, and we hit a high water mark of 14 about a month and a half ago, and we're back up to a dozen now of clubs, and an awful lot of them in the top 10 there. That's a new record for, not a new record, but it's staying at the highest level in clubs in the top 10, and we have 3 of them in the top 10, which is pretty interesting, pretty nice thing to have.
I do like to point out that every time the market kind of takes a breather or starts behaving normally, whatever that is, the ones in italics, those are the celebrity groundhogs, tend to drift down the list. and David has almost disappeared, and there were several others in italics not that long ago. So kind of a fascinating thing. We'll also have number 26. We'll have a Janet Blazer moment here in a little bit. So Janet checks in at 26th, and Cy Lynch did sneak onto the list. His Braves kind of had a tough end of the year. I figured just as a gesture of kindness, we'll sneak him on there at 41st. All right, let's keep crunching. All right, here's a quick update on a stock that we have talked about. The ticker symbol is NAPA, one of our favorites around here. And the Duckhorn portfolio has had really some tough sledding here over the last year or so, as you can see pretty clearly by the chart from upper left to lower right. But this is the price that people were or close to. It was actually bought out at $11.10, just like it shows here. It's a pretty good one-day jump, huh? Not bad. And one of the reasons we bring it up is just as a quick reminder, we keep track of the stuff that we do here. Not just here, but other places where we do and say things. These are from 2 of the National Convention stock panels. And you can see for the 2023 one, which I believe was a virtual one, I had selected Duckhorn, and I selected it at 14, and didn't do quite as well as Pat Donnelly, the gentleman who obviously stole my idea.
The luck of the Irish, you
The
know.
luck of the Irish. And Pat has slightly different results from his Duckhorn purchase. You'll hear us talk about Susie Artsberger, one of the technical gurus at Better Investing. And you can see she's got some pretty high flyers there on the most recent list, but a little bit of humility with Scholes down at the bottom there. But overall, Susie just does a fantastic job of identifying opportunities. Anything on here grab you, sir?
I don't like to be the bottom 2 choices on the most recent list, but other than that, nothing else strikes my fancy, Mark.
Well, it's early.
I'm just happy that you're joining me with the 3rd worst. So,
Well, and you've got Louis. You really need to break this fixation you have on Lou and Louis.
yeah, I know Louis and Lulu and Luminar. Okay.
It's okay to, when you're flipping through the pages of your value line, it's okay to go, away from the K's, L's, and M's. You can, whatever it takes. All right. So anyway, again, we keep track. The other thing that kind of rankles me is every time this one comes up and I should pull the trigger on it, I don't. Next thing you know, it's at number 1 for Pat Donnelly from a little over a year ago. All right. A little bit of quick news that kind of turned into a learning opportunity. I believe this was sent to me by Ted Brooks. Ted is in the audience, and Ted lives not too far from here. I don't know if he's got a microphone, but he actually reported that these 2 quarries, which are fairly close to a vacation property he had somewhere in that area, have been very adversely affected by Helene. And we were comparing notes, and he was showing where this stuff was at. And I just thought this is kind of an interesting opportunity. And again, the question I think is probably typical or should be typical of how you think about a situation like this. This is a fairly rare commodity. And I guess the question I had was, well, how rare is it? So I asked the artificial intelligence machine, and in this case, it was ChatGPT, how much of this stuff is sourced from that spruce pine location. I think this qualifies as significant. Correct me if I'm wrong out there, anybody. But that's a pretty big deal. Now they're not going to be shut down forever. I don't know if Ted's able to go live, but I'm wondering if they've given any further estimates as to, their first concern was for their people. Second of concern is that all the bridges into that area are out. So they may have to come up with a different way to transport the stuff around for a while, but it's a mess. Just thought it was an interesting opportunity to demonstrate how, if you haven't tried this yet, you can access a free version. Kind of fun to ask a question like this and see what you get.
Mark, Ted is on the in the audience today, and has his hand up. So, Ted, you're unmuted. Go ahead.
Okay. Hey,
Hey,
Mark.
Ted. How are you, Ted?
Doing good. How are you?
You're safe, marking yourself safe from the hurricane, and
Oh, yes. Just to clarify your comments, this is not near where I live. We had a vacation home that was not too far away, which fortunately we sold earlier this year. There are actually two of these mining operations in Spruce Pine. And interestingly, one of them, I made numerous trips to the landfill while we owned this particular property and would have to drive literally right through one of them. So looking at this, there's several issues here. If you see, and if you go out to the various places, I went out to the North Carolina Department of Transportation. To get the main thing here is there's a US Highway 19 which goes to Interstate 26, which appears to mostly be intact, but it's the roads that are in and around the quarry that's going to take to get there. The US Highway appears to be open, though impaired. So it is a question of how soon these will come back on, and then what are the implications, both for the semiconductor industry, which is directly impacted here, and also for basic materials that are going to be needed all up and down the Appalachian Mountains for rebuilding. So,
what is
Ted,
go ahead, Ken.
Ted, this is Ken Kavula. We just spent 2 weeks in Black Mountain on vacation. Is this anywhere near Black Mountain?
Okay, Black Mountain is closer to Asheville. This is up in the northwest corner of North Carolina. It's the same. What you have to understand here is the geographic magnitude. Now, if you look at a map, the western quarter of North Carolina is all Appalachian Mountains, and this damage runs all up and down there. Spruce Pine is in Mitchell County, which borders Tennessee in the northwest corner. So you were probably about an hour and a half from Spruce Pine.
We vacationed in this area for about 55 years, so I'm very familiar with where you're talking about then. I didn't know where this particular town was, but very familiar with the area. So I'm sorry to hear that it's so much happened in that one beautiful, beautiful part of the country.
Well, yes, it's very pretty. One of the problems up there, of course, in the national news, Asheville has been getting most of the exposure. Now, being in North Carolina, we're getting a lot more local news up and down the mountain chain. Asheville is the largest city, Black Mountain being near that. But there's small communities, 5, 10, 15,000 people all up and down here. And Ken, as you know, driving around there, you have roads are cut in wherever you can cut them in. They're 2-lane, they wind. Every time you go through any kind of a valley, which of course is where the towns are located because there's enough flat land, there's a river. The rivers have washed out bridges and compromised road surfaces. You'll see places where half the road is gone. You'll see bridges completely gone. So it's a very large problem spreading across a large geographic area and hitting a lot of smaller communities, Spruce Pine being one of them.
Wow.
Yep. Thanks for your input, Ted. We appreciate it.
Our thoughts are definitely with you. Hopefully everything gets back to normal as quickly as possible. It sounds like it's a bit of an undertaking. All right, well, let's switch gears and talk a little bit about this subject. Well, this is the subject we kicked around for a couple of weeks, this notion of a repurchase strategy for company stock, including buybacks, and it's a bit of a debate. And don't blame me for the one gender boardroom that's generated by AI. So that says that they're not perfect yet when it comes to AI graphics. All right, here's a quick reminder of why we think this is important. We are debating the potential inclusion of treasury stock in that formula based on what we have learned, and we're going to go over that. And again, I think that the most important thing is it really does enable this process step as we go through some of our studies, the conditioning, the reasonable conditioning of PE ratios. And frankly, it's shaping up to be a bit of a missing link that's filling in and making our analysis even one step better. Any thoughts?
I think we should clarify, Mark, that since this slide looks very, very much like a slide that we used last week and the week before, perhaps, the major difference after Mark has talked to an awful lot of people and after he and I have both learned an awful lot of things is the changing of a single arithmetic symbol. And that plus in front of the treasury stock when we started out this discussion was a negative. So that's the change that we've made right there.
Yeah, and it's basically treated as kind of a cash equivalent by my brain, but it really does make an interesting difference. So I talked to George from Houston and a couple other people, and Diane chimed in with some fairly comprehensive looks at a couple of the companies that we have kicked around a bit. So Diane's background is in accounting. So Diane, feel free to chime in wherever you see it necessary.
Will
Mark,
do.
before Diane speaks, could you identify the gentleman on the left here? I know that he was the kind of inspiration for this whole line of reasoning originally, and I can't come up with his name right now to answer a question. Can you give us his name again?
His name is Joel Greenblatt. Very
Greenblatt.
Yeah,
Okay.
Greenblatt. He wrote the book, The Magic Formula That Beats the Market. This is basically a modified Joel Greenblatt formula, and the modifications are simple. We substituted liabilities for total debt. Now we're putting in the treasury stock, and then this is very important. Just like we do on a stock selection guide, we're projecting the operating income 5 years out, so that we can look at an average profitability situation going forward. So those are the two minor adjustments that we made to it, and it's turned out to be fairly useful because of this reality that it compares very favorably to the PAR, the return forecast that we build during our stock studies. So Joel Greenblatt, he's also a professor at one of the Northeastern schools, and again, a very successful investor in his own right. So here, just a quick tour through some of the companies we mentioned last week. These are some of the companies that have different forms of share repurchase buyback programs. And you can see Apple has taken a number of shares off the table over the last 10 years. As I go through these, pay attention to the scales, both the x-axis and the y-axis. Some are 10-year charts, some are much longer than that. And then, of course, they don't start at zero. So that's not saying that Apple shares have gone to zero. It's saying that they've gone from 22 something down to 15 something. That is a third of outstanding shares from 10 years ago have actually been bought back. And we're going to take a little bit closer look at that one. Microsoft kind of surprised me a little bit. You can definitely see the inflection point in the mid decade. Around the year 2005, 2006, they have since then been net purchasers of their own stock. And then, of course, you can see Google down there at the bottom. The thing that all these businesses have in common, strong cash flow and some cash in the checkbook.
You know, another point, Mark, just because these charts are before 2018, Apple really started on its march for buybacks as a way to repatriate its foreign earnings through the back door without getting taxed. They actually took on debt. They bought shares back with debt, not because they couldn't afford it, but because they didn't want to bring cash back onshore. and they're probably the single biggest example of having done that. So I think they all have a degree of that, but of course the tax laws change since then, and they continue with the program.
Yeah, and they also had
Yeah,
very low interest rates. Go ahead, Ken.
before you get off this slide too, Mark, I think we should re-emphasize the necessity to keep your eye on that, especially the scale on the right-hand side of each graph. A lot of them look like there's precipitous drops, but the drops are not all of equal consequence. Google, for example, has dropped about 1 billion versus Apple's, which has dropped from 22 to 17. I'm sorry, to 15. So we have make sure you look at the scales to understand that they're not all doing exactly the same thing. They're doing the same thing with general trends, but not with specific trends.
Okay. Here's a couple other companies that are among the leaders in terms of the amount of repurchasing that they're doing. And here's a great example of that. Berkshire Hathaway, definitely not at zero. And again, pay attention to the scale over here. They have purchased a substantial amount, but they've gone from 1.6 something to 1.4 something in total of million shares. And last but not least, these three companies round out 10 of the more commonly recognized companies that are doing buybacks. We'll talk more about ExxonMobil later. You can see that they've had an up and down history going back over 30 years. And Home Depot, by the way, Silence's shares were purchased on the left-hand side of that Home Depot chart, and he still owns them, but quite a decline there. Now, Diane, you had commented there's been recent legislation which could or should have some impact. Did you want to comment on that here?
Yeah, the Inflation Reduction Act in 2022 said that beginning in, I think it was January of 23, the government could impose a 1% excise tax on the market value of share buybacks. And there is some exceptions, but again, I'm not into taxes these days, so I don't know the full potential impact of that, but definitely could change how some people view this activity.
Yeah, and with interest rates coming back down, who knows? Maybe that offsets some of that, but taxes are a deterrent, so it's part of the deal. All right, one of the people that we talked to, Bakul Lala, suggested that perhaps the cash should be taken out of this formula, and just wanted to, in the interest of completeness, basically, I understand where he was coming from, but we basically are looking at this enterprise value thing just for the reasons that it says up here. I'm not going to read it to you, but the important thing here is if you didn't subtract the cash, you'd be counting it twice in the method that's being pursued here. Keep in mind that we use liabilities, total liabilities instead of debt, and then again we're basically adding in the treasury stock. But it's a pretty good summary of how this stuff would be done, and pretty good treatment of the subject itself. Again, just a definition. I found it useful to be reminded that companies have these authorized shares, and as George Mack explained, companies will basically do just about anything to avoid making a change either up or down in their authorized shares, because it has to be a very formal and bureaucratic process. So they basically stay pretty much constant. So we are basically talking about the difference between issued shares and outstanding shares. And again, a buyback takes and removes outstanding shares, and then the company will make a decision about whether to retain them as treasury or, as we'll walk through with Apple, basically net out instead of keeping the treasury shares. Any comments or questions here, Ken?
No, I think it's very clear, Mark.
Okay.
My comment gets solved on the top of the next slide here.
Okay, go ahead.
Because truthfully, I mean, once they started issuing stock options back in the day, which was a way to offer major compensation without actually it being salary. You know, theoretically, the options were performance-based, and everybody started using options to pay management. Well, now you have to have stock available to fulfill those obligations. And that's really when I think the buyback trends really started, was to acquire stock to not have these additional share issuances cause dilution.
Absolutely. And in fact, as we'll see in the case of Apple, they turned it into a bit of a science with respect to the employee compensation and that kind of stuff. So you can see the various reasons there from top to bottom. And the one that kind of bothered us was the situation of, if we could disregard the treasury stock, how could we possibly, and we covered this last week, how could we possibly disregard the fact that ExxonMobil used $40 billion worth of Exxon treasury stock to buy Pioneer. So obviously it had considerable value, and wanted to have a little bit better understanding of the situation. Now you can see that there are some notable names missing from this chart. We just told you Apple does a buyback. We're going to go into that, and they don't do the treasury stock, but they do kind of their own flavor that we'll discuss. But again, kind of an interesting situation. Here's Kevin Gologli's McDonald's, and you can look and say, well, they don't have a whole lot of cash, but when you actually bring the treasury stock into it, they've got more treasury stock plus cash than their total liabilities. And again, I think that's fairly significant. And you can see from top to bottom here, we're talking about some fairly substantial amounts, especially relative to their long-term debt loads and their total liabilities. The ones in blue, for those that are wondering, those 6 companies are among the Manifest 40 most widely followed companies. Anything else here, Ken, you would like to make a point on?
I'm just trying to take all this in, Mark. I think the bottom line is that it makes the proved number even make more sense when we put it together, and it erases a little bit of the disparity that we see in proofs sometimes.
Mm-hmm. All right, so here's the case with Apple. Again, we've already talked about how they have a declining shares outstanding balance, yet there's no treasury stock on display for the last 10 years. And this was really, really gnawing at me and bothering me. And that's why I talked to George and Diane and a few other people, trying to get a better understanding. So here's a summary, and then we'll look at some of the details that Diane steered us towards. I mean, they do have a significant stock buyback program. We see that. And they actually do have a form of treasury stock that they use. And we'll cover that. I could almost put quotes around this. Fair enough, Diane?
Right.
So, but that doesn't mean they're not doing it. And I think that this helps a little bit. It doesn't get me all the way home, but I sort of get it, that if those shares are retired and not left as treasury stock, you are making kind of a, and I don't like the word permanently, but something more solid. It's a more solid signal as far as the financial health of the company. Because don't forget, they still have those authorized shares. They can always reissue shares, which would be dilutive. So anytime that they are taking these shares out, they are making a statement about the financial condition and strength of the company. So again, depending on who they are and their situation, that these are the types of things that dictate the logic behind treasury stock. All right. So this is where Diane turned us. Diane, can you kind of take us through? And I had forgotten, it's been a while since I looked at some of these reports. I'd forgotten that they actually are pretty transparent about what they're doing.
Well, the first place you would see activity, there is a consolidated statement of changes in shareholder equity. And that's a primary financial statement, just like the balance sheet, the income statement, and the statement of cash flows. Yeah, okay, here you are. So you should at that point be able to see the activity. It's not netted. So you will be seeing issuances as well as repurchases. And in some cases, those statements only show the dollar amounts, and you'll have to go to the footnotes to find the actual number of shares. There are disclosures in the footnotes, and particularly of interest, which you bring up later, is looking at the average price that they're paying for these buybacks. In some cases, buying back stock is not the best use of company funds. And you have to decide whether you like that or not when you are making your decisions about how the company, how management is operating the company. You will see that the dilutive effect of instruments, whether it's convertible debt or the stock options, those shares are considered in calculating diluted EPS. And that's why we want to focus on that number, because if those shares are in a position where they could be issued, we want to take that into account. So particularly if you use the preferred method in doing your SSGs, you really want to make sure that you're using dilutive shares.
Yep, it's a great point. We basically do that for every company at Manifest that we cover. So, and the other thing that really kind of knocked me out a little bit was the relative size of the share-based compensation versus their total payroll, which is shown right here. I just inserted that at the bottom just to make that comparison. I do not know how that compares from company to company, but it would be hard pressed to call that insignificant. They use a lot of stock-based compensation, would be my take on that. So it's not insignificant, and as Diana suggested, they do kind of net out. And here's the question she was getting at. I mean, you can
Mark,
actually
before you go off that last slide, did you go back there?
This one?
Nothing under the operating expenses indicates that that's entirely compensation. How do we know how much of these numbers in R&D or in the selling line is actually devoted to compensation?
Well, I tend to think of the total compensation picture as the SG&A. I don't know technically what R&D would be. You want to talk about total paychecks, basically, is what you're looking for?
Well, I'm wondering, I mean, under operating expenses, if you had to buy computers for, if you had to buy 300, if you had to buy a big mainframe, where would you expense that under operating expenses? Would it be a part of selling general and administrative, or would it be part of research and development? And does that mean that the 24 billion that I'm seeing in selling general administrative is not all salary?
It's a good
For
question.
sure, it's not all salary.
Okay.
And there is
Okay.
going to be salary in research and development.
Okay, so I don't have a feel for then how much of the salary number is taken up with share-based compensation. Is that right?
And I
think it'd be hard pressed, yeah, to figure it out. There might be something in the footnotes, but I don't think you can do it just based on the statement.
Yeah, I was a little bit hesitant to compare those two numbers. That's all, Mark. Okay.
Yeah, and I realize what you're talking about too. It's a bit nebulous, but I was just looking at relative size. In other words, I'm not looking at a number up top that's 1% or 2% of the number at the bottom. It's much more than that.
Okay.
So again, just on a relative basis, and I do not have a feel for that number in general.
So if we wanted to say roughly 20% of the operating expenses are being handled by share-based compensation, would that be a fair statement to make?
As a comparison, yeah, I think.
Okay.
I'll tell you where you can really get a feel is go to the proxy statements and look at how much the executives are getting paid.
I was just thinking that.
their salary is probably like $1 million, but their share-based compensation is going to be like 14 million. It's where the majority of those executives' salary comes from.
Yep.
Mark, I have a hand in the air from Ted Brooks, and I'm going to unmute Ted and let him speak, okay?
Yes, sir.
Ted,
Yeah.
go ahead.
Hey, Ken, just want to clarify one thing you mentioned on research and development expenses. if you buy, in this case, you would not be buying mainframes. You'd be buying racks of servers and desktops, what have you.
Yeah, it was a dumb expense, but that you got the idea. Go on. Yeah.
No, let me finish, Ken. Okay. If you are buying computers, that is a capital expenditure.
Mm-hmm.
Okay.
Okay.
Because they have a lifespan of more than 1 year, you would capitalize them and then depreciate them over X years.
Right.
Okay.
So it'd show up in a different place.
So you're putting it in a different. Your expense would be therefore depreciation.
So might this include something like insurance, an insurance payment, or something like that?
Yes.
Ted? Okay.
Insurance would be done for 1 year or less, so that is an expense that would be under SG&A.
Good stuff.
Makes absolute sense. Thanks a lot, Ted.
All right, let's go ahead and tackle the crucial question. This is one that we probably will dig into a little bit deeper because it really does tell you, at least it gives you a hint about, how management is behaving and, perhaps a little bit about the logic. So was their purchase, which is fully delineated for us to look at right there, was their purchase made in July 2023 a good buy? And from our view of the world, it's certainly questionable. You're basically buying at a moment in time when the price was relatively high. The return forecast was basically near a multi-year low, and maybe could have been prudent to wait a little bit. In any event, they basically are. So I'll just leave it at questionable. It sugarcoats it a little bit, but we'll leave it at that for now. So again, here's
Mark, having taught thousands of classes of mixed ability learners, can I restate what you said for another group of learners in our audience?
You absolutely can.
We teach people to buy stock when this red line is at a high point, because that indicates that the par is historically both backward and forward higher than it's ever been. And those are opportune moments to buy stock. And the company, in fact, has decided that they're going to buy stock at a low point, which makes their decision to buy not a very good one. That's exactly what Mark said, but I think I'm putting it in different language. Maybe some other people understand. Yeah.
Absolutely. And you have to generally basically think about these as just another person out there buying stock.
Yeah.
I would maybe expand that to say it was not motivated, let's say, by return on that investment, right? Some companies may have a specific policy to offset those employee options to offset that dilution by buying it back. It's sort of throwing money away, but we are looking at it at a dollar and cent sense, which a business should overall, but sometimes they have more specific policies.
Well, Matt and I are. I'm sorry. Go finish up, Matt. Finish up.
See, one of the most joyful parts of having been a Panera Bread shareholder is they had a very rigorous statement. They had a very robust share buyback program and a very rigorous statement that they considered that among all their other capital investments and would not buy if it didn't have a 15% return on them. And despite much analyst pestering. They had many quarters that they had a lot of cash and didn't buy anything back because they held that very rigorously. And so it does exist, even if it's rare.
Yeah, I remember you talking about that, and we were also Panera shareholders, so we experienced a good thing.
And Mark, where I was going with my argument, and Matt kind of filled in some of the gaps, where I was going with it is when we talked about when to sell a stock or when to buy a stock, either one, it makes the same kind of argument. But when we're talking about when to sell, and we said you have to sell when you need the money. And that's the only real reason I can think of for buying at the point where they chose to buy right here. They needed those shares. And Diane just told us a while ago that they sometimes need to go out into the market and buy those shares so they can turn around and use it for executive compensation.
Yeah, they certainly do. So yeah, but again, you could still question the strategic moment. They're basically looking at intrinsic value and that kind of stuff. So we'll just leave it at that for now. So here again is the formula. Um, and again, we don't need to go too deep into it. I do think this notion of basically deferring compensation or making it a different flavor so that as you're basically providing an avenue to leave off current day salaries, which will raise operating income. So again, you can look at the strategies and just give it some thought. But again, um, they really should be buying when the company's in the buy zone, just like any of us would do. Okay, so with that, one of Ken's other requirements for doing this kind of stuff is you got to be able to get to the information easily. This is straight from Morningstar. If you go into the financials, you go to the balance sheet. You got to go down into the detailed view and scroll down, but you can see that treasury stock is fairly prominently presented. So you have the ability to get this information on any company that you're reviewing. And obviously, we'll be talking about it a little bit more, but I think some of it's starting to fall into place. It's certainly shaping up to be a bit of a missing link and maybe a last element of fine tuning on the way that we look at the proved calculation. It's not making a
Mark,
massive difference.
I
Go
will
ahead.
say, Mark, that the Morningstar site has a really nice search function to it. And if you searched the term treasury stock, it led you to this place right here. So even if you forget what Mark just said about where to find it, use the search and they'll help you come up with it on any one of these company websites here.
All right, now I'll close by thanking George, Diane, and John and others that have chimed in on the subject. Any closing thoughts, Diane,
Nope,
on this subject? You're good to go for now. All right, I'm
I
sure we'll
am.
come back to it in some cases. So let's move on to the best small companies, our quest for this year. Small cap is not necessarily a small company, and Ken wants to find companies that are up straight and parallel, no matter how small they are. This is a pretty powerful chart, guys. This is from our Russell 2000 Growth ETF from a year ago. You can see that the performance dates are Halloween last year, and I did not manufacture this list. This just happens to be the top 25 or so performers from last year. We picked several of these for the best small companies for the year, and we actually looked at Sezzle pretty carefully. That one got away from us, Ken, but pretty good list of companies, very powerful numbers, and just absolutely a validation that this is a interesting place to go shopping. Now, there's a couple of Kavula rules in effect here. You'll notice that all of these earnings are positive. Go go ahead and
Thank you.
go ahead and
Thank
chortle,
you.
Ken. And what
Thank you.
and
Thank you.
remind me what's Kavula rule number one?
Oh, Kavula, when you're looking at a list, if you don't recognize one or two of the stocks on the list, then don't look at the list.
Okay. Well, you own some of these, so thank you.
I own 3 or 4 of them, so this is a great list as far as I'm concerned,
So thank you,
and
Matt, Kim, and
it
others.
bears study. It bears study. Let's put it that way.
Very powerful potential. That's all the point we're making. So we invite Ken to go ahead. We're gonna run over a little bit, but I think it's worth it. So let's go ahead and take it away, Ken.
Well, I did this small company thing at Ticker Talk in 2 different sessions, and I get so many questions about small companies. I've been championing small companies since about 25 years, and I very quickly came up with some standards when I was looking for these small companies because number one, I didn't want to waste a lot of time, and number two, I didn't want to find companies that were just purely speculating on what they might be in the future. So I set myself some goals, some rules, some ideas, and I've kind of stuck with them over the last 25 years or more. So let's click again into the next slide, Mark. And here's the standards that I demand in a small company. And here's the standards that I love to demand on our small company list, although occasionally I get outvoted or I get pushed into the corner, one of the two. I really want to see up, straight, and parallel on a small company visual analysis. Now, I might only get 2 or 3 or 4 years of it rather than 8 or 9 or 10 years of it, but I do want to see some up, straight, and parallel in the most recent history, and I want to see a blue line. I want to see some profit. I want to see a line that can be parallel to the sales line. You can't have parallel with a single line. And I keep saying that to people. They show me a stock, it has no earnings to it, and I say, you can't use the stock selection guide. And I get quizzical looks, especially from folks that are just beginning the whole idea of studying smaller companies. I want enough history that I can begin to get a rough idea of how management is handling the transition from the top line to the bottom line, from revenues to actual earnings per share. And I'm willing to ignore choppy growth in the first year or 2 or 3, as long as I have 5 or 6 or 7 years of history where the last 2 or 3 or 4 are up, straight, and relatively parallel with each other. I know that a lot of small companies in the very beginning are going to be choppy. I'm not worried if a company has 10 years of history and the first 3 have no earnings, as long as they begin to earn and then continue to earn. Next slide, if you would,
Yeah,
Mark.
I might also inject that Nicholson was also pretty stringent on, he wanted to see how a company, especially a small company, performed during a recession. So that's what the 10 years are there for in the first place. He wants to see what actually happens. How'd they handle it?
My second rule is to actually look at small companies. And I know Better Investing talks about $1 billion or less. I happen to personally think that that number is now too small, especially with the inflation that we've dealt with in the last couple of years. And I think you might go up to $2, $2.5, or even $3 billion and still be looking at classic smaller companies. I wouldn't be hidebound by this 1 billion or less in the most recent fiscal year of sales. I still like to look at sales. Remember that with asset-based companies, you don't look at sales, you look at assets, and those asset numbers are going to be different. We might discuss that in future bull sessions, but those asset numbers are going to be different. I'm just going to tell you that our bank people in our community have told us that a small bank probably is a bank with less than $10 billion in assets. That's 10 billion in assets for a small bank, and you might even stretch that as far as 12 or even a little bit higher. I want to see sales growth in double digits. A small company that's not growing its sales in double digits isn't going to belong in my portfolio because it's not going to pull its weight. That's the whole reason that I'm having smaller companies in the portfolio to start with. And I don't mind having a giant company in the portfolio that's growing at double digits. I don't know what to call it except to call it a faster growing company. I think we get saddled a lot of times by these words, small, medium, and large, and maybe we should be talking about slower growing, medium-sized growing, and faster growing in the discussion that we're having about the 3 types of companies. I want earnings growth to meet or exceed the sales growth. I know that in smaller companies, you're quite often going to see earnings growth for 2 or 3 or more years exceed sales. Yes, I know that can't continue forever, but it's quite common when you're looking at smaller companies. If you're looking for a chant, put this one on the wall and memorize it. Earnings follow sales and stock price follows earnings. Everything starts with sales. You can't have a stock price if you don't sell anything. And if you sell something, you have to make money for the stock price to move forward. Next slide. So where do you look? Well, you know, I like the Small Talk series from the Rocky Mountain chapter. I like the Wednesday Morning Breakfast Club from the Heart of Illinois chapter. I like the Round Table from my own chapter. That's the granddaddy of all these programs. Been doing it now for over 14 years. And I like the Digging into the BI Magazine program from the DC Regional chapter. These are just examples of great small company discussion programs that are happening within our community. And where do you find them? Well, go to your own chapter to start with and look for local events. Next slide, if you would, Mark. And you can get to our community tab in the BI website. It's in the upper right-hand corner. There's a tab called Our Community. Once you get there, you can click on My Chapter for your own chapter, and then you can click on Other Chapters. If you know that the Rocky Mountain chapter in Colorado's putting on a great program, then go to Colorado, look for the Rocky Mountain chapter, and they will give you information on the local events tab on how to sign up for their program and on when they're producing their program. Next slide. This is the best source of information that I've had for the last 25 or 30 years, and that's just talking to people. I never end a conversation with somebody that's smart and in a profession that might have companies that they access for all different kinds of reasons. I just had somebody come out and give me a quote for some retaining walls. And while we were talking about the retaining walls for my backyard, I also asked them about products that they used. Were any of them publicly traded in companies that I might invest in? And did they like them well enough to tell me they were great products? And I got the name of a single company. That's good. I found out about Manjaro and Lilly, for example, over 3 years ago by talking to one of my doctors about new potentially revolutionary drugs. And at that time, there was all kinds of buzz about these GLP, is that the right abbreviation? I think it is.
GLP-1s.
These GLP drugs, all kinds of buzz about it, not a whole lot of data, but all kinds of buzz. And so 3 years ago, I was hearing about Novo Nordisk and Eli Lilly because they were the big players at that particular time, still are today. Next slide. I also use my search function. And I'm finding that some of these AI sites are really great in giving me lists of companies that deal with certain topics. Now, the lists are not just full of buys, but they're a great place to begin to look for companies. I've been really interested in small modular reactors. That's nuclear reactors. And I've been coming up with lists of companies that are dealing in this particular area. My most recent area that I'm really, really heavy duty interested in is methane pyrolysis. And what that basically is breaking down methane into solid carbon and pure hydrogen. Methane is CH4 for you chemists in the audience. And that means it only has carbon and hydrogen in the atom. And if you can break it down into solid carbon, which you can then sell, by the way, and break it down into pure hydrogen, which has a huge market, by the way, and do it relatively cheaply, then you have a great alternative, and you're not putting carbon dioxide into the atmosphere. I love this idea, and I'm looking for companies. Bill Gates, as usual, has beaten me to the idea, and he's interested in a company out of Snohomish, Washington, that is doing this very thing right now called Modern Methane. You might take a look at the company. It's not public at the moment, at least. Next slide.
Yeah, we'll be digging in deeper on this as we go forward. Matt, I actually told Ken that I'd be really, really interested if they were producing graphene also.
Well, I'm not sure they're doing that, okay? I love this predefined small company screen. I just press this button once every 4 or 5 weeks. And since I've been doing it for 4 or 5 years, I know which companies are new to the list, and I can then look and see if I know anything about them. Most of the time when they're new to the list, they're new to me, and that gives me some more ideas. This is where Technoglass originally came from, this list, and then it was verified by Forbes magazine when they ranked it #1 in their best small company list of last year. Next slide. I like ideas. I'm going to continue to revisit this idea in more ticker talks, and I'll bring some more of this idea on how to actually study these companies back to the bull session as well in the next couple of weeks.
Sounds good, Ken. So this is the one we were just demonstrating. We will continue to check that one between now and Halloween, and we will turn to some of our other sources. Today I thought we would take a quick look using the Morningstar and Diane's presence here. Oh, by the way, here's the current listing for Ken's favorite screen, the small company's predefined screen at Better Investing. And the one that jumped off of here, which one was it, Ken? It was
TBBK.
TBBK.
Oh, well, you like Ator. Okay,
Yeah,
TBBK.
we're going to be looking at that one along with some other companies, and then also
Yeah.
this one. And unfortunately, it probably gets red carded by its description on the right there. But this is just an example. I'd never heard of this one.
I didn't either until I did this list about 2 weeks ago. Mark, go back to that list for just one moment, if you would. That bottom company has stayed on this list now for almost 2 years. And that's quite a feat to stay on this extremely difficult screen to make in the first place, and then to stay on the screen for a long, long time. This is a Canadian company, but it does trade in the US, a very, very interesting company, Descartes Systems. I would take a look at it if I were you.
All right. So switching gears to again, our effort to find ideas for companies for the best small company list. This is the current fund manifest. Again, the idea is to keep track of institutional funds who seem to know what they're doing. We're measuring a minimum of 10 years experience in market outperformance. It drops off dramatically from there. You guys all know that. And the one that comes up here today, again, many of the smaller funds, smaller company funds, have drifted down and off this list because of the tough times for the small caps and smaller companies. But in this case, we have Oberweis microcap checking in at an average sales growth rate of 16%. Again, a little bit lower quality, a little bit friskier, but you can see that the returns are higher, and they have managed to do fairly well over the last several years. We have the additional benefit that Diane was directly affiliated with Oberweis several years ago. So
Many,
Diane,
many years ago.
many, many years ago, but you did work, or you know Jim Oberweis.
Yes,
You're doing your pretty
yes.
well. How would you describe Oberweis? In
Well, he had what he called the Oberweis octagon, which was 8 points of things he was looking for in these smaller growing companies. And basically, a lot of those points follow the kinds of things that we're looking for in terms of sales growth, earnings growth, competent management. But I will agree with your description of sometimes they are frisky.
Yeah, and I think we'll pull out that octagon and take a look at it and see how it would apply. And the only other thing that they probably do different is they have a pretty stringent bailout if it goes down a certain amount to protect themselves against the downside of some of these. But you can see long-term, pretty powerful performance over time, just backing up what we just had to say. So here's a look at the top 25 positions in the fund with the ticker symbols. And again, all we're doing here is looking for ideas. This is a screening technique, not passing any judgment on any of these other than to just simply notice companies which might be more interesting to our community. And this is probably even more telling, diving deeper down the list to some of these companies. Some of these up here have done quite well, so they may not be as attractive. That's why their percent of total assets are as high. They've done very well, and perhaps they're maybe the bandwagon has left the barn, or whatever metaphor you want to throw at it. These are relatively new purchases in many cases, or very significant adds fairly recently or within the last year. So again, from top to bottom, they can be an interesting thing to take a look at. So quick reminder that as we go through this effort during October, we do this every October, we are not ashamed to borrow or steal ideas from wherever we can find them. And you can see where some of the ideas for the last week have come around. And in our weekly update, we will actually share some of the companies that might be worth a closer look. Now, Diane was scouring the Value Line Small and Mid Cap edition, so we'll take a look at a couple of those as we go forward. What are your thoughts on some of these, Diane?
Well, I'd like to just briefly talk about my process. Most anyone who knows me knows that I'm a big value investor and I really like my dividend paying stocks, but that portfolio is pretty set. And now that I'm retired, I'm having some real fun looking for the next up and comers. So I go to the library once a month and I get out that Value Line edition, and following an old line from Ellis Traub, I look for stocks that have those lines that Ken likes, at least in terms of the stock price. Back in the day, I used to read Investors Business Daily, and I loved the New America column where they were featuring all these innovators and new companies. And one of the things that I gleaned from that is that we should not be afraid to buy stocks that are hitting new highs. So when I go through that Value Line, I'm looking for stock charts that have some upward trajectory to catch my eye. Next, then I'm looking at the sales line, and then I go down to the quarterly box and see if they're making any money. And particularly when a company just starts turning earnings positive, I get real excited. Just like, I like to see the earnings, but more important than that, I also look at the cash flow line and make sure that there's cash flow that exceeds the earnings. We want our companies to be sufficiently able to fund that growth internally, as opposed to always having to go out to the capital markets. So Shift for Payments is one of the companies that caught my attention that way. You'll look and see, it doesn't really look like they're hitting a new high, but if you go back to 2021, it is hitting a new high over the last 3 years. When it went IPO, it got very excited, and these things get overpriced. And then what happened was COVID, basically. The company sells a payment processing service that is more comprehensive than what's offered by Square or Toast. And they also service many more industries, hospitality, amusement parks, entertainment, and sporting venues. And that's what's been in the news recently, that this sales growth is coming from a very aggressive sales force that is going out and talking to everybody and trying to get them to appreciate the value added by this company's software. What caught my eye at the Value Line was a little notation that they had just signed the Minnesota Vikings, and that they had also acquired a small software company that they were going to integrate into their suite products. And as I went exploring, there are numerous press releases. The second quarter letter to shareholders is really enlightening, and that's where I like to go with some of these little companies to actually read what is behind driving these numbers, because we really want to understand, can the company continue on this trajectory? And that's where I'm always looking for, what is the catalyst, what is driving these numbers? And in this case, they have signed not only Minnesota Vikings, the Pacers, the Colts, Miami Heat, and the Bears. And then in the hospitality arena, they have added Nobu Restaurant in Chicago and Toronto, and they are expanding internationally and as well as domestically. So I felt really good about the sales forecasts, and I admit I bought this over a month ago, and it's the three companies that I ended up recommending and are all up 20% basically in a month. So
Nice.
people, do your own studies.
This one actually popped out of the Oberweis portfolio. Kind of fascinating that the ticker symbol's RSI, but you can read on the right there, they have to do with uh, um, electronic gaming, and obviously out of Chicago by the Rush Street reference, but you can see very early stage, but pretty exciting growth. Probably not enough blue points to make Ken comfortable yet, but at least that green line is headed in the right direction. So it's just an example of, again, this is, I'd have to call this one quite frisky and certainly very early stage, but they do have a top line track record, and the bottom line track record is beginning to take shape. So with that, Diane, did you have any other comments on the rest of these four?
Well, like I said, Harrow is drug development. They actually bought a drug from Novartis that Novartis didn't think they could get proper repayment for, and Harrow has succeeded in actually trying to reproduce this, and they got the repayment numbers like quadrupled. And apparently this is like been unavailable. This drug has been unavailable for about 5 years. And so it's now very close to being delivered. The other company, Vertex, is involved in tax software for all sorts of not really income-based, more things like sales and use taxes, VAT. But they have recently partnered with Salesforce to get their software into the Salesforce suites. So
Good stuff.
But as I said, both of these have been, if you look at the stock charts, it's like they've taken off in the last month. So
we should have had you a month ago. Darn it. I would also point, Ken and I have found this to be kind of a useful thing to keep track of, especially with any recessionary type concerns. Those are all pretty robust sales forecasts for 2025 versus 2024. So it's one of the things that we watch as we look at these smaller companies. Here's the current small company list, just real quickly to go through. Certainly not a final list. It's very preliminary. Some of these will fall victim to updates. I did expand the par range a little bit along with the prove, put in a financial strength of 40 and a earnings per share stability of a minimum of 40, just to keep Ken from losing consciousness, and did up the revenue just a tiny bit just to expand the field. And again, this is just for kind of check in. We are going to talk about ACM research when it comes to Buttonwood. So again, very preliminary, but this is kind of how it's shaping out, and it'll be fascinating to watch this over the next few weeks. All right, so Ken, here we are, Buttonwood. We're just going to go through a very quick rendition of a club meeting this month. We'll come back in greater detail next month and talk about some of the other details, but in this case, it's actually doing pretty well. And you can see that the company with the lowest projected annual return, the return forecast, is Viva Systems. So that would be the challenge stock. You can see that the sector diversification is pretty good. If we're going to add a company, might want to slow down on adding discretionary, but nothing else is way out of line. What are your thoughts in general about the portfolio,
Well,
Ken?
the only number that we don't have displayed is the MyPar number. I think it's 8 point something right now, isn't it, Mark?
Call it 9%.
9. Okay, so
It's
we're
average stock.
we're 3.7% above my par. Our goal is to beat it by 5, but 3.7 is darn good. And with Viva at 8.1, I don't think it's that much below average for us to deal with at the moment. I did quite a bit of reading in the last 10 days about Viva, and the outlook appears to be extremely positive, especially based on the fact that Viva does a lot of its business by contract. It's not exactly a contract, but they make well, an agreement is a contract. So I guess it's contracts, and the contracts are pretty sticky with their different customers. So Viva has a large amount of business that carries over year to year that's already set by signature. So I'm pretty pleased with it. There you're getting a rough idea right here, and this is a particularly positive article that Mark has chosen to quote, but most of the articles that I was able to access were of an equal bent. The analyst community really likes the company. They feel the stock price has kind of plateaued while the sales and earnings keep moving in an upward direction, and they feel that it's primed to maybe go back to its former highs and maybe surpass those highs. So I think we would keep Viva. If this were my own portfolio, Mark, I'd be trying to add to one of the stocks that I have a high conviction on, that has a smaller percentage of the portfolio. So I'm looking at the bottom of the total growth, or the percent of total column, and I'm seeing Virtra, Luminar, which I know that we bought as speculation, so I'm not going to add more to those speculative stocks. I get to Excellus, Lululemon, and Diageo, and I'm looking at the sales growth to go along with those three stocks, Excellus, Diageo, and Lululemon. And boy, do I like Lululemon's sales growth potentially. So I'm going to suggest we put another $50 or $60. Remember, we're working with really small numbers here, folks, because it's a real money portfolio and we don't want to lose our shirts.
Well,
But I would suggest we put another $50 into Lululemon, and then choose from one of the three at the bottom to take about 130, 140, 150 bucks from.
yeah, I'll see your 50 and raise it to 75. I think Lulu is, I mean, maybe we're just being stubborn, but it continues to look pretty good. And in fact, Diageo would probably be the next one I would look at to challenge with the lower growth rate here. And I'm a little bit upset with my Duckhorn buyout. So I'm having an alcohol moment, adult beverage
Okay.
moment.
Which one
So
of the three from the bottom do you
from the
favor,
bottom,
Mark?
well, I think Lamb Weston. I love French fries, but that one kind of D-Local. Not so sure about the. It's very early stage and a lot of competition out there in the global transaction processing. Even though we have Excellus, which is kind of a number two to Applied Materials, so it's in the same realm. I really do still like ACM Research because they basically represent and serve virtually anybody who makes chips, and the cleanliness of their process. So here's a look at the two systems. Again, the article, it may be extremely optimistic, but it's by Selena. Selena wrote it just a couple of days ago, so how can you go against Selena at the Motley Fool? And just, okay, that was a stretch, but they have been in a flat spot for a while. Here's Lululemon. They have spiked up in projected return because the stock price has come down a bit. The only thing I see here that kind of concerns me is Value Line has kind of tempered this to the downward trajectory out on the 3 to 5 year forecast. but I'm with Ken. Everything looks good for now. I'd say toss another 75 at that. And then when it comes to ACM research, again, fairly early stage company, but upper teens for the projected return. It would have been great to buy it last week or last month at a much lower price, but still pretty decent. So I think we'll take those two portfolio actions and then do a more comprehensive review come November with
Sounds
the
good to
Buttonwood
me, Mark.
portfolio.
Sounds real good.
All right, so let's go for that. Here's our weekly reminder that we do archive all of the bull sessions and roundtables on the YouTube channel, Manifest Investing, so you can take a look at that. If you subscribe, we'll let you know anytime new content is added. Here's a quick thought about some stuff that we're working on right now. We will be coming back to this Family Inc. book about every family needs a CFO for an extended family. And then during the Breakfast Club for Heart of Illinois chapter, this book came up and I've actually been going through it to refresh some of the stuff. In fact, this actually came up in the context of share repurchases and buybacks, and there's some interesting materials in the book, so that's there for the undertaking. Went back and I was searching on the subject of toilet paper because I went to Costco the other night and all of the toilet paper was gone. So I went to our website, searched on toilet paper, and I found this. Do you remember this session, Ken?
I certainly do, Mark.
It's a good one, and it's got some real gems in it, including this one, which is a stark reminder about toilet paper. We had actually presented this during that session. What I find fascinating is all these people that are concerned about interruptions in shipping, as in boats and stuff coming from other countries. Well, everybody, first of all, toilet paper demand is actually pretty much a constant. It doesn't really go up and down that much over time. And the other thing that's probably news to a lot of people, all of it's made in the United States by the companies on the right. So I was standing and discussing this with people at Costco and falling on disbelieving or inattentive ears. Apparently, I don't know. So anyway, I just thought we'd
It's the kind of
revive
thing
the
that
moment.
costs more to ship than it costs to make. So it's very short supply chain.
But we definitely want it. But we do have this proof that you can survive without toilet paper if you really had to. But then you got to have Russell, the good doctor, along for the ride too. All
Mr.
right.
Emmerich has suggested, Mark, that your discussion has gone down the toilet now. Okay.
Of course it has. All right. Anything else other than Steve Emmerich in the hopper?
Nope, we're all caught up with everything. Thanks a lot to Matt for answering a few of the questions, and we're quite a ways over today, so we should wish people a great afternoon and hope we see them next week.
And thank you so much, Diane, for your contributions and for helping untangle some of those mysteries. Thank you so much.
Loved it. Keep in touch.
All right. Thank you. All right, Ken. Talk to you soon.
You too, Mark.
Good luck out there.
Good
everybody.
afternoon, everybody.